Hi, and welcome to the Macro Show. We talk macro, try to make sense of markets, and who knows what's really going on. But I'm your host, Steven Van Metre. In today's episode, we're going to talk about the eviction crisis. You know, I keep hearing people talk about all this pent-up demand. There's just so much money in everyone's pocket and stacked full in their bank accounts that they just can't wait to get in their cars and airplanes and ships, go to their favorite theme parks, travel to foreign lands, and just throw money like it's going away. Yeah, I don't think people get it. I really don't. There's when you face an insolvency event, there's a reason I did that video. I don't know if it was last week. I think it was, because there's two sides of this economy, and some people really just don't understand that the situation's much worse than they realize. And so we got to address that, because this pent-up demand that people are seeing in the charts, I don't think is real. I get what the charts are saying. We're going to look at it. We got to look at the speculative positioning. Now, why do we look at the speculative positioning every week? Because it tells us where people are at. And when markets get too lopsided, all on one side or all on the other, like a teeter-totter, well, some of the easiest things to do is just take the other side of the trade, because when everyone's all in one place, you can't go any further. That's the bond market, of course. Now let's get into this, pent-up demand. And where do we get this view from? Oh, look at the M2. Look at all this money in checking and savings accounts. It's just, people are just flooded with money, and it keeps rising at ridiculous rates. And my gosh, where is it all coming from? I mean, it's like some magic money tree, right? I mean, look at all of this money. And yet here is a report that came out in August that said, look, there's an estimated 30 to 40 million people in America facing eviction. Now, maybe, and I want you to open your mind to this, maybe this just isn't a bunch of pent-up demand. Maybe it's people who can't afford to pay their rent or their mortgage, and they know they're going to lose their home or their apartment. They have nowhere to go. They have kids to feed. They have their own self to feed. They have a family to take care of, health insurance, clothes. So maybe they just started putting money away because they don't have any other choice. They don't know what to do. Check this article out. It's really interesting and frightening at the same time. An estimated 30 to 40 million people in America could be at risk of eviction in the next several months. Now, this was August. Now, keep in mind, the stimulus and all of these things are keeping this thing from becoming a big issue, because the eviction moratorium ends, I don't know exactly when this month, but I know it's toward the end of it. We know the pandemic unemployment insurance ends on December 26th unless it's extended. But look at this. Throughout the COVID-19 pandemic, researchers, academics, and advocates continued to run an analysis of this. And what did they find? Existing research related to the housing crisis, including estimated potential upcoming eviction filings, unemployment data, housing insecurity, and all these have gone, and they've determined that 20.8 million renter households, which is almost half, I mean, that's staggering, were already rental cost burden. What does that mean? Well, it's defined as households who pay over 30% of their income towards rent. That's crazy. Right? I mean, that is a burden. With 1 in 4 spending over 70% of their income toward housing costs. And guess who's been hurt the most? Of course, by the pandemic. Those who made the least. Of course, it would also help if my neighbor would go turn the alarm off on his motorcycle that's going off. Thank you. All right, let's take a look at the charts here. And what we can see is number of households that are facing risk of eviction. Almost 13 to a little over 17 million. Number of people at risk of eviction, 29 to almost 40 million. That puts 29 to 43% of all households. All households are facing eviction. That is crazy. And then yet people have the audacity to say, look at all this pent-up demand that's going to just drive so much spending. The issue we have here, my friends, is maybe there is enough money out there to deal with this, insolvency event. There isn't. In a debt-based economy, there never is. But if it's not in the right hands, what good is it? If the wealthiest people are sitting on a bunch of money and, 30 to 40% of households are facing not having a place to live, how is that going to increase discretionary spending? How does that turn into pent-up demand? That's families trying to feed their kids and put roofs over their heads during the winter. Look, I'm not saying it's better during the summer, but gosh, it's pretty bad during the winter. And this reminds me, my friends, of, if you're a student of history and you study the Great Depression, the Roaring '20s, which oddly we're being compared to now, but I can tell you in one way, the rich in the Roaring '20s got richer. And you look at the history books and it makes you think that everybody benefited, and that's not entirely true. Most Americans did not experience any gains from the wealth. Now, did they benefit from new technologies and cheaper goods and services? Yes, but no, by no means did they have anything close to the amount of wealth that was created for the wealthy, chasing stock prices higher. But eventually the music stopped, right? This is just musical chairs. When you're in a dollar shortage, the music eventually stops. And I'll tell you what, the big comparison, right? The big comparison to the 1920s and now is the wealth control, the rich control of the wealth. If you look at the stock market today, over 99% of all stocks are owned by 50% of the population. The richest 50%, no doubt. Obviously, if it was the other, they wouldn't be worried about facing eviction. And what you have is a middle class, the rich and the wealthy, all chasing each other higher. How high can we bid stock prices? Because maybe those 50% on the bottom, maybe they're going to buy. And if they do, that'll be great because we can all sell. You mean those same 50%, those 30 to 43% that are facing eviction, they're going to buy stocks? No. And eventually the music stopped in the 20s. Credit was contracting, was constricted by the Fed raising rates, no different than what we're seeing now. And eventually it ran out of buyers. That's how this whole game ends. Eventually people cannot afford to pay higher stock prices, home prices, asset prices. And finally, when it all is done, there's only one way it all goes, down. And when it goes down, brings treasury yields down. Asset prices, treasury yields crash. Bond prices go up. That's the comparison. So when I hear about all this pent-up demand, I don't think those 20 to 40% of households are thinking about vacations and discretionary spending. I think they're worried about feeding their kids and putting a roof over the family's head. I think that's what they're worried about. Now let's take a look at the speculative position. See if there's so what we're looking for is any change. Does this validate my view that there's going to be a big surge in bond prices, a crash in yields? And you'll see that it does. Let's look at the 10-year Treasury note futures, up slightly, insignificant. It's interesting to me that hedge funds, are slightly bullish on the 10-year bond, but mega bearish on the 30-year. Again, as I mentioned, I think this is due to the home building optimism index, where the home builders are super optimistic, and you're seeing hedge funds trying to front run just huge demand in 30-year loans. I don't know if it's going to work out for them. I don't think it is. What you see is a small increase. Now, of course, friend of the show, who has a big place in the kingdom, Brent Johnson of Santiago Capital, generously feeds the king's addiction for this chart every week. And he sent me the commitment of traders report for the 30-year long bond, which is seen here on Hedgeopia, but in a longer term chart, a little bit more detail. And he sends me this and says, hey, the change went up 4,600 contracts, which is largely insignificant. There's still a massive short position. So when people say, look, interest rates can only go up, look, you've already seen everybody that can possibly sell this thing sell. Maybe there's a few more people, but there doesn't appear that there's a whole lot left to go. Now, I pulled up the commitment of traders details on the Commodity Futures and Trading Commission, and here is the U.S. Treasury bonds. These are the long ones, the ultra and the Treasury bonds. And what we see is dealer intermediaries. So these are actually the securities dealers, and they increase their short position. So whoa, wait a minute. What do you mean dealers increase their short position? That is bad, right? Not necessarily. You got to understand the dealer's position, right? They're buying at auction and they're resellers. What is the risk right now that the market is telling the dealers? The risk is that rates are going to go up, because that's what the market's doing, is trying to drive rates up. Now, dealers are naturally short. I mean, and if you're having trouble understanding this concept, maybe put it in a way that you might understand. Like, how about a car dealer, right? So let's say a car dealer gets a bunch of cars. Now, is there risk that they sell those cars for a higher price than they bought it from? No, that's exactly what they wanted to do. But what if the risk was maybe there, was a slowdown in sales, or maybe a model wasn't very popular and they had to sell it at a loss? Well, think of that from a dealer's perspective. They're just hedging their downside risk. So naturally, dealers are going to be short. But these are pretty big short positions for the dealers. Not the biggest in history, but they're pretty large. And all it's telling you is the dealers want inventory, but they're just concerned about their downside risk because that's what the market is telling them. I mean, again, you're seeing persistent selling at all avenues, options, futures, contracts. How can people short the long bond? And what will happen though is as bond prices rise, the dealers will be the first to should back out of these positions because they don't need them, right? If bond prices are rising and they're in the green and they can sell them for a profit, they're not going to need to short or be as short. I think that's more the key. And then that will flow across over into the leverage funds that will get squeezed out. And that's the opportunity. People look at the bond king and they said, well, man, this guy's crazy, right? How can he think interest rates are going up? Because everybody's short. Everybody's on one side of the teeter-totter, except on the other side is the large commercial banks and the Fed. And one thing that no one's really factoring here, and I'm going to do a special show. I'm hoping I'll have it done next week, maybe even for Christmas, because obviously there won't be a show on next Friday. I know, boo, right? Well, yeah, no, there won't be any economic data to talk about on Friday, but maybe I'll have the special edition on QE out, and it's kind of interesting because all you hear about is QE drives rates up. Yeah, well, it's not really not that at all. I mean, the fact higher rates from QE are almost minuscule. In fact, the QE2 rates went down. So it's going to be a really interesting show. But you see here again, everybody's lopsided on the wrong side of the fence. And we have the Fed meeting tomorrow and then the press conference on Wednesday. And there's been murmurs, right? Murmurs that the Fed could extend the duration of their purchases out and buy fewer of the shorter term notes and buy more longer terms. Look, the Fed's already helping us. And if they do that, it's even going to help more because all the Fed is doing is chipping away every week at these short positions. And at some point, they're going to get bond prices up enough, and you're going to see this massive unwind that the market is not prepared for. Let's take a look at some of the other futures positioning. We've got West Texas Intermediate. Again, people are bidding crude oil up when there's a 15 million barrel build. And now we're hearing from the mayor of New York, it may be a total lockdown. I mean, we already have states under restriction, people sent home, can't go to work, and yet everyone's bullish on crude. I mean, we'll look at the inventory levels on Wednesday relative to their seasonal average. And to me, it doesn't make sense in how people can be. I know they're saying, oh, don't worry, supply is going to go down. Well, what if demand goes down faster, which was what we're seeing? How about on the S&P 500? So hedge funds are getting a little nervous, starting to put some short positions on the S&P and increase them a little bit, concerned about downside risk. How about the euro? And now this should keep the dollar a bit depressed, right? Because the euro is the largest of the trade-weighted dollar. So we're seeing euro futures back up as people still believe that there will be a stimulus package from the U.S. and somehow this one will be inflationary, even though I think we've shown that the true gauge of inflation is a money multiplier, and stimulus isn't going to change that picture very much. How about gold? Contracts up a little bit. Again, this market is very bold up on gold, but as you know, I think it's headed lower as inflation-adjusted yields head higher due to a declining consumer price index. They're back along the NASDAQ, which is kind of interesting. No concerns now on the short side from hedge funds. How about the Russell 2000, which is crazy that to me that people are bidding up U.S. small caps like we're going to have a massive resurgence in the economy. It's not looking like that, not at all. How about the dollar? Big increase in short positions. Now we're almost back to that level before as everyone puts the big bet back on a weaker dollar. Remember, at some point when everyone is on one side of the fence, boom, it's going to go the other direction. So expect that at some point we get a bottom in the dollar. And how about volatility futures? A little increase there, but fairly stable for the last several months, as investors are betting on lower volatility, but not willing to overcommit to it. And if that bond piece unwinds as I expect it to, well, you're going to see volatility spike. Let's take a quick look at the economic calendar, and then we'll take a look at a few charts as we have time. Some good news out of Japan. The Tankan Manufacturers Index, diffusion indexes, all came out a little bit better. As we've talked about, things in Japan are pretty bad, but this is a little bit better. So that's good news coming out of the fourth quarter there for Japan. How about capacity utilization up 6%? That's a good positive sign, showing the factories are being utilized a little bit more. And we see preliminary industrial production out of Japan up a little bit. Let's get into today's data. Not a whole lot here. Eurozone industrial production improving. This is pretty decent improvement from minus 6.3 to minus 3.8. It is October. And as we know, things in Europe started under restriction before the U.S., so we should expect the industrial production numbers to go back the other direction in the months that come. And we still don't have the export data for South Korea, so let's go take a look at some charts, see what's going on in the bond kingdom, and of course, today what happened? Well, let's zoom in, and the overnight trading. Well, inflation, back to the walls of the kingdom. In case you're wondering, the walls of the kingdom are right here, down in here. We have to breach through a lot of castle before things are really a problem. But again, keep in mind, the Fed is reducing the supply of 30-year treasuries. It's amazing that people still think they're going to be worthless. They don't understand how QE works. So anyways, defended again the walls today. There's a lot of support here. At some point, the sellers get tapped out. You'd think they were pretty close to that. But today's price action was pretty good as it came down, and then buyers stepped in and brought prices up. How about the equity market? Didn't like the news at all. And it started up higher, started up quite a bit higher as stocks gapped up, but did not like the news out of New York that perhaps there'd be a total lockdown there. Gold mine stocks, I'll tell you this. As you know that I am bearish on gold mining stocks in the short term, and even if bond prices aren't going up today, the fact that gold mine stocks are going down tells me the bond prices are going to be going up. So this is not a good picture for the gold miners, still under their 200-day moving average. And we saw oil stocks started to head back down pretty big today, hitting resistance here, as we talked about in the Sunday chart show. But again, we come back to this demand issue. Everyone thinks you just shut off supply. I'm not sure people understand that the more supply you shut off, the more high-paying oil company jobs that go away. And that leads to, the oil companies spend a lot of money in the economy, a lot of money into the economy, and less of that being spent is not good for the rest of the economy. It just isn't. So everyone's bullish on crude, but I remain not. How about the dollar? Look, trying to make a bottom in here around $90.40. Will the dollar hold? And some of you are shaking your head saying, no way, the thing's going down, down, down. But of course, if you understand how quantitative easing works, then the Fed's trying to defend the dollar. I mean, people are betting on the wrong end of the Fed. Now, in the short term, and even in the intermediate term, they can be right. In the end, they'll be wrong. Be sure to like. Thanks for subscribing. I do appreciate all of you support the show. I did get to the comments. I'll check out the ones from the Sunday chart show soon. And we'll be back on Wednesday to see what Sorcerer JP had to say. And hopefully he gives the Bond King some good news, or even better news. Maybe they'll increase the QE purchases, and that'll be great. Thanks for watching. I'll see you soon. Bye now. The content of this video is provided educational information only, is not intended to provide investment or other advice. It shows not to be construed as a recommendation or solicitation by Social Security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre. All person capacity opinions expressed in the video do not reflect the value of financial advice or Steven Van Metre Financial. Boom!